The Federal Reserve held interest rates steady at its late April meeting, and the minutes released this week explain why that decision was harder than it looked. The Federal Open Market Committee voted to keep its benchmark rate unchanged at the April 28th and 29th gathering. The minutes, which came out roughly 3 weeks after the meeting, give markets the clearest picture yet of how policymakers are thinking through a difficult combination. Slowing growth on one side, sticky inflation on the other. That kind of tension is not new for the Fed, but trade policy has made it sharper. Tariffs imposed earlier this year have pushed up import costs for businesses and consumers. That adds upward pressure on prices at exactly the moment the Fed had been hoping inflation would keep cooling toward its 2% target. Instead, price pressures have stayed elevated, complicating the math for rate cuts. At the same time, some economic data has softened. Growth signals have weakened in places, raising the question of whether the economy is slowing fast enough, or too fast, to justify holding rates at current levels much longer. That is the bind Fed officials described in the minutes. Cut rates too soon and you risk reigniting inflation. Hold too long and you risk doing more damage to growth than necessary. The minutes suggest officials are not in a rush to resolve that tension. The language points to a committee that is patient, data-dependent, and reluctant to move until the picture gets clearer. That is not a dramatic shift, but it does matter for markets, because the minutes reveal the reasoning behind the vote, not just the outcome. Unexpected divisions in tone or risk assessments can move bond and currency markets, and traders watch these documents closely for any hint that the calculus is changing. For now, the April minutes appear consistent with a Fed that is watching and waiting. There is no clear signal that a rate cut is imminent. What officials flagged instead was elevated uncertainty around trade policy, around how tariffs will feed through to prices, and around whether the recent softness in economic data is a blip or the start of something more sustained. The next scheduled meeting is in mid-June. Between now and then, fresh inflation reports and jobs data will give policymakers more to work with. Those numbers will likely do more to shape the Fed's next move than anything the minutes themselves revealed. The practical takeaway here is straightforward. Watch the incoming data, not just Fed statements. The June meeting decision will be built on what the numbers show between now and then, and that is where the real signal will come from. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.